Debt is one of the most misunderstood words in the world. For most people, debt feels emotional. It feels heavy. It feels stressful. It feels dangerous. When someone says, "I'm in debt," it usually means trouble. But before we talk about countries, governments, or trillions of dollars, we need to understand something very simple. Debt is not evil. Debt is not a trap by default. Debt is a financial agreement. That's it. At its core, debt is when one party borrows money from another party and promises to repay it later, usually with extra money added on top. That extra money is called interest. Let's break that down clearly. If you borrow $1,000 from someone and agree to pay back $1,100 next year, the extra $100 is interest. That $100 is the price of borrowing. Why does interest exist? Because time has value. If someone gives you $1,000 today, they lose the opportunity to use that money themselves. They could have invested it. They could have spent it. They could have earned money from it. So interest compensates them for three things. First, the time their money is locked away. Second, the risk that you might not pay it back. Third, inflation, because money in the future is usually worth less than money today. This means debt always has two main components. The principal, which is the original amount borrowed. The interest, which is the cost of borrowing. That's the basic structure. Now here's something important. Debt is not automatically bad. In fact, most economic growth in modern history was fueled by debt. Businesses borrow money to expand. They borrow to open new factories. They borrow to hire employees. They borrow to invest in equipment. Students borrow to invest in education. Families borrow to buy homes. Entrepreneurs borrow to start companies. Debt allows people to use tomorrow's money today. And that can accelerate growth, if used wisely. But here's where things become interesting. There are two types of debt: productive debt and unproductive debt. Productive debt creates something that generates more money than the cost of borrowing. For example, if a business borrows $100,000 and uses it to buy machines that generate $200,000 in profit over time, that debt created value. Unproductive debt does the opposite. If someone borrows money to buy things that lose value, expensive clothes, luxury items, vacations, and those purchases do not generate income, then the debt becomes a burden. So debt itself is neutral. It becomes good or bad depending on how it is used. Now let's connect this idea to countries. Countries also borrow money, but they don't borrow for shopping or vacations. They borrow to fund budgets. They borrow to build roads, schools, hospitals. They borrow to support the economy during recessions. They borrow during wars. And sometimes, they borrow simply because spending is higher than tax income. But before we move forward, there's one more key concept you must understand. Debt is built into the modern financial system. Now that we understand what debt is at a basic level, we need to answer the next big question. How does a country actually borrow money? Because governments don't go to a local bank and fill out a loan application. They use a different system, one that operates on a global scale. The main tool governments use to borrow money is called a government bond. A government bond is simply a formal promise. It's an official document that says, "Lend us money today. We promise to pay you back in the future, with interest." That's it. But the scale is massive. Instead of borrowing $1,000 or $10,000, governments borrow billions, sometimes trillions, of dollars at a time. So who lends them this money? There are several major groups. First, banks. Second, pension funds. Third, insurance companies. Fourth, investment funds. Fifth, foreign governments. And even individual investors. When you hear about US Treasury bonds or government securities, this is what they're talking about. Let's simplify it with an example. Imagine a country needs $100 billion to cover a budget deficit. Instead of raising taxes immediately, the government issues bonds worth $100 billion. Each bond might promise something like, "We will pay you back in 10 years, and we will pay 3% interest annually." Investors buy those bonds. In exchange, they receive regular interest payments, often called coupon payments, and eventually, their original money back. Why would investors buy these bonds? Because government bonds are often considered low risk, especially if the country has a strong economy. For example, bonds issued by large economies are seen as relatively safe because those governments have strong tax systems, have large economies, have the ability to print currency, have a history of paying back debt. Investors want safety and stability. Government bonds often provide exactly that. Now here's something very important. When governments issue bonds, they are not borrowing from one single lender. They are borrowing from the entire financial system. That means the debt is spread across millions of investors and institutions. This makes the system more stable. Now let's talk about maturity. Every bond has a maturity date. That is the date when the government must repay the original principal. Some bonds mature in 1 year, some in 5 years, some in 10, 20, or even 30 years. This structure allows governments to manage their cash flow over time. They don't need to repay everything at once. The repayment schedule is distributed across many years. But here's where things become even more interesting. Governments rarely wait until maturity and then pay off the debt using saved money. Instead, when a bond reaches maturity, the government often issues new bonds to pay back the old ones. This is called rolling over the debt. Let's simplify it. Imagine the government borrowed $100 billion 10 years ago. Now the bond matures. Instead of paying that $100 billion from tax savings, they issue a new $100 billion bond. Investors buy the new bond. The government uses that money to repay the old bondholders. The debt continues, just with new investors. This process can continue indefinitely. And as long as investors trust the government and believe it can continue paying interest, the system works. Trust is everything. If investors believe the government is stable, they continue lending. If they lose trust, interest rates rise. If interest rates rise too much, borrowing becomes expensive. And that's when problems begin. But we are not there yet. There's another key concept we need to understand. Interest rates. The interest rate a country pays depends on their inflation expectations, their economic stability, a political stability, a credit rating, or overall investor confidence. If a country is seen as risky, investors demand higher interest rates. Higher interest means higher future payments. Lower trust equals higher borrowing costs. That's why countries care so much about their credit ratings. A downgrade can increase borrowing costs dramatically. Now think about the scale. If a government has $20 trillion in debt, even a 1% increase in average interest rates can mean hundreds of billions of dollars in additional annual interest payments. That's enormous. And that's why debt management becomes a central part of national economic policy. Governments constantly monitor interest rate levels, economic growth, inflation, investor demand, because their ability to refinance debt depends on these factors. So now we understand something critical. Countries don't borrow randomly. They use structured financial instruments, bonds. They borrow from global investors. They spread repayment over decades. And they continuously roll over old debt with new debt. Which brings us to the next big question. If countries can keep refinancing forever, why does debt even matter? And because existing debt must also pay interest, that interest adds even more pressure to borrow. This creates something called structural deficits. It means the system is designed in a way that naturally produces debt growth over time. But here's something most people misunderstand. Governments do not aim to reduce debt to zero. Why? Because in modern macroeconomics, debt is not viewed as something that must disappear. Instead, it is viewed relative to the size of the economy. This is where we introduce one of the most important metrics in public finance, the debt-to-GDP ratio. GDP stands for Gross Domestic Product. It measures the total value of goods and services produced by a country in 1 year. Think of GDP as the country's income. Now compare debt to GDP. If a country has $10 trillion in GDP and $5 trillion in debt, that's a 50% debt-to-GDP ratio. But if the country has $10 trillion GDP and $20 trillion in debt, that's 200%. This ratio matters much more than the total debt number alone. Because if the economy grows, the country's ability to manage debt improves. For example, if GDP grows 5% per year and debt grows 3% per year, the burden actually becomes smaller over time, even if the total debt number increases. This is the key idea. Governments don't focus on eliminating debt. They focus on keeping it sustainable. Sustainable means the economy grows fast enough. Interest payments remain manageable. Investors continue trusting the system. Now let's talk about interest payments. Every year, governments must pay interest on their outstanding debt. If interest rates are low, this is manageable. But if interest rates rise significantly, interest payments can become a large portion of government spending. At that point, debt becomes dangerous, because more tax money goes toward paying interest instead of funding services. But as long as interest payments remain a reasonable percentage of GDP or tax revenue, governments can continue operating normally. And here's another critical reason debt rarely disappears. Economic growth itself often requires government spending. During recessions, governments borrow and spend to stimulate the economy. They fund infrastructure projects. They support businesses. They increase unemployment benefits. This injection of money can help prevent deeper economic collapse. So paradoxically, debt can sometimes stabilize the system rather than destroy it. Now here's something even more important. In modern monetary systems, especially in countries that control their own currency, governments have an additional tool. They can influence money supply. This doesn't mean they can print unlimited money without consequences, because that leads to inflation. But it does mean they have more flexibility than households or companies. A household cannot print money. A company cannot create currency. But a sovereign government with its own currency has more options during crises. That makes its debt fundamentally different from personal debt. So when people ask, why don't countries just pay off their debt? The real answer is, because they don't need to, as long as the system remains stable. Debt becomes a permanent feature of the financial structure. It grows with the economy. It rolls over across generations. It becomes part of the system. The real danger is not debt itself. The real danger is losing control of growth, inflation, interest rates, investor confidence. If those collapse, debt can spiral out of control. And that's exactly what we'll explore next. In part 4, we'll answer the question, what actually happens when a country can no longer manage its debt? Because history shows it can happen. And when it does, the consequences are serious. So far, debt sounds manageable. Governments borrow. They refinance. The economy grows. Investors keep lending. Everything seems stable. But what happens when that stability breaks? Debt becomes dangerous when 3 things start going wrong at the same time. Economic growth slows. Interest rates rise. Investor confidence weakens. Let's break this down carefully. First, growth. If an economy is growing strongly, tax revenues increase. Businesses earn more. People earn more. Governments collect more taxes. That makes interest payments easier to handle. But if the economy slows down, or enters a recession, tax income falls. At the same time, government spending usually increases because unemployment rises and support programs expand. That means bigger deficits, which means more borrowing. Now add the second factor, rising interest rates. If investors begin to worry about inflation or economic instability, they demand higher interest rates. Higher interest means future borrowing becomes more expensive. And here's the dangerous part. If a country already has massive debt, even a small increase in interest rates can dramatically increase annual interest payments. Imagine a country with $20 trillion in debt. If the average interest rate is 2%, that's $400 billion per year in interest. If rates rise to 5%, that becomes $1 trillion per year. That's a massive difference. At some point, interest payments can start consuming a large portion of the government's budget. When too much money goes to servicing debt, less money is available for healthcare, infrastructure, defense, and public services. That's when debt pressure intensifies. Now the third factor, confidence. Debt systems run on trust. Investors must believe the government will continue paying interest. If investors lose confidence, they may stop buying new bonds. Or they may demand extremely high interest rates to compensate for perceived risk. This can create a dangerous spiral. Higher interest rates, larger deficits, more borrowing, even higher rates. If this spiral continues, the country can face a debt crisis. And in extreme cases, it may default. A default means the government cannot meet its debt obligations. It either delays payments, restructures the debt, or refuses to pay fully. Defaults have happened many times in history. When they occur, the consequences are severe. Currency collapse, banking instability, capital flight, economic contraction. But here's something important. Large economies with their own currency have more flexibility than smaller countries. If a government controls its own currency, it can technically create more money to meet obligations. But this leads to another risk. Inflation. If too much money is created too quickly, prices rise. If inflation becomes extreme, it can destroy purchasing power and destabilize society. In extreme cases, this leads to hyperinflation, where prices rise uncontrollably. So governments walk a tightrope. If they borrow too aggressively, risk increases. If they print too much money, inflation rises. If they cut spending too fast, recession deepens. Managing national debt is a balancing act between growth, interest rates, and confidence. This is why debt itself is not the true danger. The danger is mismanagement. The danger is losing control of the economic balance. Now here's the key insight. Most advanced economies do not collapse because they actively manage these risks. They adjust taxes. They adjust spending. They work with central banks. They influence interest rates. The system is constantly being adjusted. And that brings us to the final question. If debt can be dangerous, why does the system still function? Why hasn't it collapsed already? After everything we've discussed, you might be thinking, if debt keeps growing, if interest payments can explode, if crises are possible, why hasn't the system collapsed already? Why do major economies continue functioning year after year, even with trillions in debt? The answer lies in one powerful word: scale. Large economies operate at a scale that changes the rules. When a country has a massive economy, deep financial markets, strong institutions, and global influence, its debt becomes embedded in the global financial system. Government bonds are not just loans. They are foundational financial assets. Banks use them as reserves. Pension funds rely on them for stable returns. Insurance companies use them to manage risk. Central banks hold them as part of monetary policy. In other words, government debt is not sitting on the outside of the system. It is the system. This creates something very important: demand. There is constant global demand for safe, stable assets. Large government bonds are considered some of the safest assets in the world. That demand allows governments to refinance continuously. Now let's zoom out. Debt grows over time. But so does the economy. So does productivity. So does technology. So does population. so does overall wealth. As long as the economy grows at a healthy pace, debt becomes relatively easier to manage. Remember the key metric: debt to GDP ratio. If GDP grows steadily, even a large nominal debt can remain sustainable. Now here's another powerful reason the system continues working. Inflation. Inflation reduces the real value of debt over time. If a government borrowed money 20 years ago, that money was worth more back then than it is today. As prices rise gradually over time, old debt becomes easier to repay in real terms. Moderate inflation can quietly reduce debt burdens without dramatic policy changes. This is one reason central banks often target low but positive inflation instead of zero inflation. But the system is not magical. It relies on confidence. Investors must believe. The economy will grow. The political system is stable. The government will honor its obligations. Confidence supports demand for bonds. Demand keeps interest rates manageable. Manageable rates keep the system stable. So debt may never fully disappear because it serves a purpose. It allows governments to smooth economic cycles, respond to emergencies, fund long-term projects, invest in infrastructure. Eliminating all debt would require massive tax increases or extreme spending cuts. That could slow growth and destabilize the economy. So instead of eliminating debt, governments aim to manage it. Now let's bring everything together. Debt is borrowed money plus interest. Governments borrow through bonds. They refinance rather than eliminate. Debt grows because deficits accumulate. It becomes dangerous when growth slows, rates rise, and confidence falls. But the system survives because debt is integrated into the global financial structure. The real question is not, will debt disappear? The real question is, can growth, stability, and confidence continue? As long as the answer is yes, the system holds. If the answer ever becomes no, that's when the world changes. And that is why debt is not just a number on a screen. It is one of the most powerful forces shaping the modern economy.